How does monetary policy maintain price stability? Imagine a central bank as the thermostat for the economy's temperature. It works to keep prices steady so that things don't get too hot or too cold. That's what we call price stability. When prices rise too fast, it's called inflation, and when they fall or stay low for too long, it's deflation. Both can cause problems for families and businesses. So, how does the central bank keep prices just right? The main way is by controlling the supply of money in the economy. If there's too much money floating around, prices tend to go up because people have more to spend. If there's too little money, spending drops and prices can fall. Central banks adjust how much money is available to keep inflation in check. They also influence interest rates, which are the cost of borrowing money. When they want to slow down inflation, they raise interest rates. This makes loans more expensive, so people and businesses borrow less and spend less. That cools down demand and helps keep prices stable. On the flip side, if the economy is slow and prices are falling, central banks lower interest rates. Cheaper loans encourage borrowing and spending, which can boost demand and push prices back up to a healthy level. They also buy or sell government securities in the open market to add or remove money from the banking system. When they buy securities, they put more money into circulation. When they sell, they take money out. This helps influence how much money banks have to lend. Another tool is forward guidance. Central banks tell the public what they plan to do in the future. If people believe interest rates will stay low, they are more likely to borrow and spend now, which can help prevent prices from falling. If they expect higher rates, they might save more, which can slow down inflation. All these actions work through what's called the transmission mechanism. Changes in interest rates affect how much people and companies decide to spend or save. When interest rates go up, borrowing costs rise and demand drops, easing upward pressure on prices. When rates go down, demand increases, which can help prevent prices from dropping too low. Central banks also pay close attention to what people expect prices to do. If everyone believes prices will stay steady, they are less likely to ask for higher wages or raise prices preemptively. This helps keep actual inflation close to the target level, often around 2%. In times of economic downturn, central banks might lower interest rates or buy securities to encourage spending and prevent prices from falling. When the economy is overheating and prices are rising too fast, they tighten policy by raising interest rates. This balancing act helps keep inflation low and stable, creating a predictable environment for everyone. So, through careful management of money supply and interest rates, central banks work to keep prices steady. This stability helps people plan their budgets, businesses set prices, and the economy grow smoothly without sudden jumps or drops in prices.